In today's video, let's take a quick look at the double exponential moving average and compare it to the exponential moving average using our famous now long-only strategy on Bitcoin USDT on Binance. So, as you may know already, the goal of this channel is to test multiple strategies that are based on technical indicators, especially on crypto and especially on Bitcoin, and then to trade a portfolio of these strategies, using as much as possible uncorrelated versions of these strategies among the best that I find. And today you can see on the chart, for example, in green, the double exponential moving average, so another type of moving average after having tested in the past videos the simple moving average, the exponential moving average, the Kaufman adaptive moving average, the volume weighted moving average, and yesterday the whole moving average, and today the double exponential moving average, which reacts faster to the price due to its specific calculation and also smoothes out the noise as much as possible compared to the exponential moving average, the simple one in orange here. So both I've chosen here with a length of 100, and you can clearly see that the green line is faster compared to the orange one. So when there is a starting trend in the price action, the green line reacts way faster, it's way more responsive. So let's take a look at the results of the strategies that I apply to all these moving averages with a long only rule. So essentially we would have entered a long when here in the daily time frame the candlestick closes above the green line at about $45,000 here on Bitcoin, and then the long would have been closed on this big red candlestick when it closes below at about $61,800 here on Bitcoin. So a trade of about 40 days. So I recommend you use the spot market to avoid the funding fees, which would be a lot in futures trading. So of course, in this ranging market here of about 7 or 8 months on Bitcoin in 2024, we would have been quite chopped out using such strategies. But instead of guessing, let's look at the backtest results together. So here is a double exponential moving average of length 330. We are looking at a big length here in 4-hour time frame. So on the top chart, you can see the price of Bitcoin in black, and in blue, I'm going to zoom in a little bit so that you can see better. We can see the double exponential moving average and the entries and exits in the form of the green dots. So when there is a green dot here, we enter a long trade and we exit here. So for example, here in this very short range, we would have been quite chopped out, but as you can see, we don't lose as much as equity as we could have imagined. So the equity curve over this about 7-year-long backtest period is very good, as you can see, because with a start capital of $1,000, we end up with about $30,000 at the end. So of course, on this quite long period of several years, Bitcoin itself would have done at about 25x, starting at about $4,000 per Bitcoin and ending today at about $100,000 per Bitcoin, so at about 25x. But here with this strategy, not only we do better in terms of X multiplier, we do on about 30x. Of course, there is some luck involved in the selection of the period length for our double exponential moving average here. And also, the drawdowns, the peak to trough drops would have been lesser than with Bitcoin. So for example, here in this in the bear market of 21, 22, 23, the loss would have been lesser than for Bitcoin, $65,000 to about $15,000, which represent a drop in value, a drawdown of about 70%. And with our strategy here, the drop would have been less than that. So the local top here would have hit $16,000, and the bottom at the bottom of Bitcoin itself would have been about $8,000 or $9,000, so about minus $7,000, which is not even a 50%. So it's quite a big drawdown, yes, but less than Bitcoin. And that's what we are trying to do using such strategies on this channel. We are trying to reduce the drawdowns as much as possible, as well as get an overall performance which is good. And obviously we are not going to use only one strategy. That's why I want to trade a portfolio of as much as possible uncorrelated strategies, which entries and exits that are possibly different, and also equity curve behaviors that are different. That's what I'm looking for. So for now, I've tested only long-only strategies, especially on moving average types technical indicators, but we are going to expand and backtest multiple other types of technical indicators to vary, to diversify our portfolio. Here you can see in the daily time frame, the first column is the return multiplier of the strategy. So the double exponential moving average price crossover long-only strategy, where we compound 100% each time of our allocation to the next long trade. And the best length to choose from for our double exponential moving average in the daily time frame would have been maybe 330. So this second column shows the Sharpe ratios, which is a measure of the risk-adjusted return performance, and when it's above 1, it's annualized here, it's generally considered very good. The only problem with the daily time frame, and it's usually the case with other moving average types strategies as well, the number of trades is not very high, and that's a problem for me because for our algo strategies on this channel, I'm looking for strategies that trade quite frequently with backtests of 100 trades and more. Why? Because I'm looking for some, at least, statistical convictions, some statistical significance in the backtests. Let's look at the 4-hourly heat maps. So this heat map shows in the 4-hourly time frame the results of our strategy, so the double EMA price crossover long-only strategy that has been backtested for multiple lengths. So the best length in the 4-hour version of our strategy would be around 330, and this is the backtest that I showed you at the beginning of the video. So this one with a 30x in a Sharpe ratio of about 1.5, which is very good. So yes, this is essentially a very good area here in blue. And to conclude, let's look at the 2-hour version. So as you can see, there's no very well-defined area, maybe around here. But yes, the problem with that, and it's usually the case typical of the 2-hourly time frame for these strategies, these moving average types based strategies, the problem is that the Sharpe ratios are not very good. They are usually below 1 here. So let's pass the 2-hourly time frame. So now let's compare the double EMA price crossover heat map with the simple EMA price crossover heat map. So I have pulled out the two heat maps so that we can see better the results, and what I want you to notice is the difference in the length that can be chosen, that can be selected for each strategy. For the double EMA on the left, with length of above maybe 300, and with length of 100 to 300 for the simple EMA. And this is likely showing us that we can use both of these strategies in our portfolio of diversified strategies. So after having backtested the double exponential moving average, I believe that there is some kind of benefit of using not only the simple exponential moving average, but also the double exponential moving average. There is a clear difference in the backtests as well as in the way of trading. So I think there is a benefit of using both. So hope you found some good value in this video. If you liked it, please hit the like button, and also subscribe to the channel if you are new to the channel, if you want to hear from me in the next videos, in the next backtest that I will do. I see you in tomorrow's video for the test of the triple exponential moving average. Bye bye.